Regarding Bitcoin, though, our own operating procedure, we can't own more than 5% of the operating fund in Bitcoin. So we also have positions in ETH and Solana and all kinds of other, we're just looking at putting a position on in Pollen and Helium, which are really eclectic projects around decentralizing telco. But the whole point of this is that you just simply don't know when these asset classes are going to move. I have a personal speculation around regulation. I talked about that earlier, that if the Stablecoin Act gets put into law, that will be a signal that all crypto will be regulated at some point. Some people feel good about regulation, others don't. But here's a fact to consider regardless of your position. Most of the sovereign wealth funds that I work for as an indexer have zero position in crypto of any kind. When you ask them if they're going to buy anything, they want the granddaddy, which is Bitcoin. They're willing to put 50 basis points to 1% into Bitcoin when their compliance departments allow them to. And that won't happen until the SEC rules on it as a commodity or a security.
Hello and welcome to Wealthy Value. In today's video, Shark Tank investor Kevin O'Leary explains what he thinks about the current CPI inflation numbers and interest rates, his thoughts on market timing, and the importance of regulation in the Bitcoin space. Kevin also reveals how Bitcoin price can enter a new bull territory after regulation begins and why he is long Bitcoin now. Make sure to stick around till the end of this video, where Kevin shares his outlook about recession and his $100,000 price target for Bitcoin. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
Well, the way I read it was the Fed's going to raise rates 75 basis points. There's no question they're going to keep going. You're printing an inflation CPI number of over 8%. What no one knows, though, is how much of this inflation is caused by supply chain issues. Because, I've got a pretty good lens on supply chain issues. I've got 54 private companies in our portfolio. Everything from gym equipment to greeting cards, commercial kitchens, wireless charging, you name it, we're involved. And when we talk to the CEOs of these companies, they're still having a really hard time. Let's just take the gym equipment company in Fargo, North Dakota. We used to get our metal from Asia. We can't get it anymore. We can't get it through the port in Los Angeles. We have to make the barbells and all the gym equipment in the US, cost 30% more. We pass the price on to the consumers. They're still buying it. And that's inflation. Now, as soon as we get the supply chain thing worked out, we'll be dropping prices, but we haven't been able to get it worked out yet. So I think half the inflation, frankly, from my point of view, is this temporary supply chain, but I don't know how temporary it's going to be. I've been waiting a year now to fix just the gym equipment story, and it hasn't been repaired yet. You got to remember something. The reason we have inflation in the first place is in the US, we printed $6.7 trillion in 30 months. What do you expect is going to happen when you print that much? The definition of inflation is too much cash chasing too few goods. There's too much money, $6.7 trillion in 30 months, free money out of the helicopter. That's nuts. Of course, it hasn't worked yet. It hasn't worked yet. I'll tell you something very interesting about this cycle. And of course, every recession has a different tone to it. We get tear sheets every Tuesday morning on revenue and free cash flow from most of our companies. So we get a pretty good read on a weekly basis. And so far, and this is kind of interesting, no slowdown yet, no slowdown. And these are consumer goods and services. So we have not seen a slowdown. And so the reason we care about this data is we're trying to make a decision, excuse me, on what we're going to do with inventory going into holiday in the US. We've got a $110 million decision to make in the next week. Do we build inventory with the assumption that demand remains constant, or do we feel in Q4 that demand will pull back because the Fed's raised rates? And so we've made the decision we're going to go balls to the wall, build out for Q4. We don't see the recession in the next few months. We think it happens next year, but we don't know. And this is the same consideration that every company's trying to make. Inventory matters in a recession because you get caught offside and your capital's tied up in inventory. But we don't see the slowdown yet, which is crazy. We can't hire anybody. Unemployment's still under 4%. And so when you try and hire anybody in food services, you can't. 15 minimum in California in a restaurant. You can't even hire people for $22 an hour. So something's really nuts here. And I think what it is that money is still sloshing around. That 6.7 trillion is still sloshing around the market. And that's why we haven't seen the slowdown yet. Everybody says it's coming. Everybody says we're in a recession. Well, where is it? I guess the
I
question
think,
the question is, where's the terminal rate? I mean, at what point do
yeah.
they indicate that they're going to stop? Because another 75 basis points already anticipated in the 2-year. You're well 4.5% on 24-month money. The stock market is fibrillating. It's having a lot of volatility. The VIX is trying to figure out the moment the Fed pauses, and so this is the interesting challenge. I don't care if you're in crypto, or your equities, or bonds. What happens in these cycles, and this is always a challenge, and we have a good example in recent times, 2020, in the middle of pandemic, total chaos around the world and the markets. The stock market actually did quite well because there was all this QE coming into it, this quantitative support, and the Fed printing money. But all of the returns, 95% of the returns came in basically 18 trading sessions, 18 8-hour periods, where you had that volatility, 2,000 points up, 2,000 points down. You just didn't know which day those up days occurred. And so if you were trying to time the market, you missed the entire returns of the year. The same thing is going to happen here. As soon as people figure out or feel or just get the tone from the Fed that they're going to take that pause, you're going to have a violent swing up in the market. And if you're not in the market that day, that's half your returns you'll miss. It'll happen in a few days. And so, everybody tries to time the market. It's impossible. Everybody learns the hard way. I did years ago. So I stay the course. I try and add a little bit on down days into just an index. I use a broad index of both mid cap and large cap stocks that Alps put out, and shameless in telling, it's OUSA and OUSM. But those indexes are 300 really high quality stocks in the US that pay dividends. And they're violently volatile, except yesterday was crazy up. So I'm glad I was in the market yesterday. Same thing could happen today. You just don't know. Timing is impossible, and this volatility makes everybody squeamish. It might happen that way, but let me suggest a different reason to start going long Bitcoin, which has nothing to do with foreign currencies, but a lot to do with policy in the United States. There's two bills floating around, but let's talk about the one that has the chance of actually getting passed in the US after November 8th, which is the midterm elections. It almost went to markup last week. It's called the Stablecoin Transparency Act. Now, this has nothing to do with Bitcoin, but it has a lot to do with the tone of regulation. And the reason I think it's interesting is they're trying to solve for the challenges that occurred in these collapses of stablecoins that were built around algorithms. 62 billion got erased. The regulators got upset about that, although the majority of that capital, because it was decentralized, was in other countries. But this act is very simple in nature, which is why it may pass. It's being supported by both parties, and the reason that's the case is that it makes effectively the US dollar the default payment system worldwide, which everybody can get behind. So if you have USDC or any other stablecoin that's backed by the dollar, and the test to get it regulated is very simple. You're going to get audited every 30 days. It has to be backed up 1-to-1 with a dollar or a treasury bill. All the treasury bills backing the coin or the token have to have a duration of less than 12 months. And if you're willing to go through that scrutiny, they'll issue you a license. Now, if that were to happen, and it may happen very quickly after November 8th if the House flips, and that's the anticipation is House flips, nobody knows what's going to happen in the Senate. That's a coin toss. But even though it has nothing to do with Bitcoin, that'll be the first regulation passed by US regulators. And I would argue you want to be long Bitcoin going into that outcome. So if you own stable coins, you're going to see a lot of interest in institutional capital coming into, let's say, USDC and Circle. Circle, by the way, took in $200 million from Fidelity and $200 million from BlackRock a few weeks ago in a Series F at a $9 billion valuation. They got $54 billion of coin. So end of the day, regulation comes, Bitcoin goes up. And I agree with your thesis that it's a good asset to have if you're in a country where your currency is collapsing. But if institutions smell policy, then you've got a real move up. And that's when you break out of this $19,000 to $22,000 trading range against the US dollar. I think it goes right through that very quickly. There's another reason as well. 45 days ago, you could take and you could lend or stake your USDC within your wallet. Let's say you had a wallet at Circle. You were making 3.8 to 5.2% for for 30-day or 6-month or 1-year contracts. That was the spread. And you were putting that out very easily on their platform. Today, the only interest you can make is 50 basis points. And you're looking at 2-year treasuries at 4.5%, there's no competition. Part of the challenge USDC has is it wants to get regulated so it can act as a sweep account and start to be competitive against bank accounts that are offering 1.5, 2% interest rates. So you have no incentive to keep your stablecoin in your wallet. You're transferring back to US dollar and parking it back in a fiat currency where you can get risk-free, basically a treasury bill for 24 months, 4.5%. Now the company's not allowed yet by regulators to do that. That's the circle for USDC. So they're in an uncompetitive situation, and it's a disadvantage. That's why they want this regulation. They can start, even if they act as a bank, they can compete with bank interest rates. But you have your money sitting in USDC, you're basically making nothing in interest. That's the real challenge. Well, his stock, along with other bank stocks last week, hit new 52-week lows. Part of that challenge is this concept of the Stablecoin Act being passed, and that specifically hurts him on ACH transfers and wire transfer fees, which are very high between banks, particularly across economic geographies. So if you're transferring from US dollar to Swiss franc through an ACH, you're going to pay a lot of fees, and you pay a lot on the SWIFT transfer as well. And those banks make millions of dollars each quarter off those fees. If all of a sudden you were allowed to use a stable coin at a fraction of that cost, and both regulators allowed for that transfer, that would really hurt profits in banks, not just JP Morgan. And so you're seeing a lot of that issue right now in the equity values. You would think as rates go up, these bank stocks would be moving north. No, they're hitting new 52-week lows. And part of this is the market trying to anticipate the disruption when it's going to happen. Here's a question for every investor to think about. There's a risk in investing in Bitcoin and all crypto. There's also a risk of not investing in it, because if it's true that it becomes the 12th sector of the S&P in the next decade, some of the value in financial services stocks, like banks, like money center banks, are going to transfer to these new technologies, and you simply don't know when that's going to happen. So my thesis is you should have some crypto in your portfolio, because you don't know when that's going to occur. And if you completely don't have exposure to it, you may miss participating in the growth of this 12th sector of the S&P, which would be a bad outcome for performance.
So, what are your thoughts about market timing in a bull or bear market? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.